Hi, happy Tuesday. So I wanted to come on here and talk a little bit about property taxes because in Montana, they're kind of a hot topic lately. So in 2024, the legislature passed a couple of different bills, and those bills affect our taxes in different ways. So in 2025, and you have to remember that in Montana, we pay property taxes in arrears, which is really weird. But in 2025, many of us saw changes in our property tax bills. Now, the little bit of confusing factor of that was that 2025 was also a reassessment year. So that also changed some things. But let's dive into how property taxes are calculated and how we can save you some money. So let's go here. So this is the Department of Revenue. And we're going to talk a little bit about, so in 2024, basically it was a tiered tax rate. And so properties were assessed at either 1.35% or 1.89%. Now in 2025, they switched to a tiered system. So the first $400,000 of value was assessed at 0.76%, and then 400,000 up to 1.5 million was at 1.1%, and then over 1.5 million was 2.2%. And they also had a rebate for your primary residence of $400. Now, in 2026, they are rolling out a new tiered system. So for primary residence or long-term rentals, the first 378,000 is assessed at 0.76. Then the median to 2 times the median is 0.90, and then 1.1, 1.9. So let's talk about how this will affect you. I'll go into here. This shows the actual breakdown. So 0 to 378,000 is the first bracket. 378 to 756 is that second bracket. 756 to 1.5-ish is the third bracket, and then anything above 1.512 is that top bracket. And then if it is a second home or a vacation rental, it's being assessed at 1.9%. So let's talk a little bit about what that looks like. So I have a tax bill from Whitefish, and you can see here that a few things we want to pay attention to. So number one is our market value. Now this is the assessed market value that the state does every 2 years. So this property is assessed at 1.2 million roughly, okay? The taxable value, which this is an important number because this is what the actual tax is based off of. So on this property, it's $11,787, okay? The mill levy is another important thing to take a look at because that's how property taxes are assessed, is by mills. And if you look at this, so this red box combined with this red box is all of the mills. So that's where we come up with that 360.727. So then we have our special assessments or our other assessments, and then that is added to the total levy and you come up with the total tax. So for 2025, this property's tax bill was $4,761.26. Now, let's take a look at what this looks like going forward to 2026. So we have that same townhouse. There's our mill levy. We're going to use the same mill levy because we don't know what it's going to be in 2026 yet. So there's our market value. 2025 shows where our total tax came from. 2026. So if this is a primary residence under the tiered system, so 0 to 378 turns into $2,872.80 worth of taxable value. Now, I want you to understand this. This is not the tax. This is the taxable value. So then we come up with the tier at this one and the third tier here. So our total taxable value is $11,055.40. Now, what you'll notice is that's actually less than it was in 2025. So we're going to use the same mill rate from 25 because we don't know what it's going to be. So we take our 11,055 times the 360.77 divided by 1,000, and that we come up with the levy tax. Then we can add the other tax from the 2025 bill, since again, we don't know what it will be in 2026 for a total. So In 2026, this property will roughly, now these numbers are really rough because we're using some assumptions in here. Total tax for a primary residence or a long-term rental will be $4,497.83. Now, let's run the same numbers if this is a second home or a vacation rental. So, same market value. Now, we come up with a flat rate of 1.9% to come up with our taxable value. So, here we come up with $22,621.40. And again, I just really want to emphasize that this is not the taxes, okay? This is the taxable value. This number is more than $11,000 more than if it was used as a primary residence or a long-term rental. So now we can calculate the taxes. So tax bill is about $8,670.49. So this is $4,172 more than if it's taxed as a primary residence or long-term rental. So we can see why it's so important that we go in and you file for your primary residence or what is being called your homestead, okay, or as a long-term rental. Now, many of you think that maybe this was just automatically done. I went to mine and I tried to check it and it showed that I was not enrolled. So I had to re-enroll my primary residence. So what you're going to want to do is click the link down in the notes and make sure you go in. You're going to need your geocode so that you can make sure that you can look up your property. And I'll also put down a link here in the notes where you can look up what your geocode is if you don't know what it is. But this is really important. Before March 1st, March 1st is the cutoff, so we only have a few more days. You need to go in, and if you live in your property 7 months out of the year and you are current on your taxes, then you can file for your homestead. And if it's a long-term rental, meaning you rent it more than 7 months out of the year for 28 days at a time to a tenant that considers the property their residence, you can file for that long-term rental exemption as well. So make sure you click down here in the notes, go to those websites, fill out the forms. It's really, really important. It could end up saving you a lot of money. And if you have any questions, please don't hesitate to reach out. Thanks for watching. Make sure you click the subscribe button so you don't miss out on any new videos. And if you have a topic you'd like me to cover, drop it in the comments below.